career over the next 15 years that was, oh, can you hear me now? Sorry, there we go. Yeah, so I was just saying, my name is Brian Bagdasarian, founder of Simply Homes. So started my career, again, in the real estate industry, underwriting homes, really understood the models on that, and ended up leveraging that into a career that took me literally around the world, applying a single version of an algorithm to everything from large scale horizontal real estate development and master plan communities to Las Vegas and how non-gaming high rollers were being identified, to the music industry in LA. And then I ended up in Dubai. Ran a fund in Dubai and Switzerland for a number of years. Long story short, moved back to the US, had a couple startups. The last one that we sold was in 2017. It was called Motion AI. If you've ever used a chat bot that was on a HubSpot landing page or website, that was our technology. And right around that time, met my wife. When we got married, I ended up inheriting some older in-laws, and my mother-in-law was living in the house where my wife had grown up. And we realized that we needed to move her closer to us. We moved her very close. She lives in our guest house. But when we got to that point, I went and I looked at the house and I put on my flipper hat, walked through the house, structurally totally fine, but it hadn't been updated since 1993. And it made no sense for us to do any improvements on that property to try to sell it because we weren't going to get an ROI. And this is something that I learned over the years, flipping homes, was a lot of times you really have to look at what is the ROI of everything that you do. So we decided to try to sell it quickly to a local investor as is. And we had an experience that anybody that's ever tried to sell a house that way probably had. They come in, they're really nice. They don't realize that we knew what needed to be done. And they start blowing out every cost for every piece that they see, all setting it up for a super low ball offer. We weren't looking for market value. We were looking for a fair as is price, as is. We ended up selling the house to somebody else, family friend. It worked out okay, but this stuck with me. And I said, this experience was atrocious. And I was talking to my partner Don. He and I have had several businesses over the years. And he's been in the industry for 30 years. And he said, Brian, he goes, this is what it is. This is what every seller deals with that tries to sell this way. And the reason why is deal flow. And I went and validated that. We found out that 96% of fix and flip and value add investors struggle with deal flow on some level. And they want to scale, but they can't find it consistently. And what they end up dealing with is they're either trying to go on the MLS and finding stuff that's out there, and it gets snapped up super quick, usually for a price that's not financially viable. Maybe they have a realtor relationship and they might get a pocket listing here and there, or they're stuck dealing with wholesalers. And there's nothing wrong with wholesalers that act ethically. The problem is that a lot of them don't act ethically. I mean, Bobby, you told me a story about someone that you and I both know that swore up and down that he was only making X amount of dollars. And you found out it was multiples of that amount. And the thing is, the industry has allowed this to occur and nobody wins. The seller ends up losing equity. It's being taken from them by that wholesaler. And on the other side, the investor is trying to shoehorn a deal when in reality, that could have been a lot more financially viable if the thing had been priced right. And so the way that we had to solve this was we had to speed up the process to actually underwrite a property. Two, we wanted to operate completely transparently. We wanted to make sure whatever we knew our investors in the marketplace knew, and that the seller knew how we were arriving at our pricing. And the third thing is that we needed to make sure that these things could be repeatable. We weren't trying to go out and just make all our money on a single deal. We built a model for volume. And with Simply, that's what we've done. We are able to solve for both the seller and the investor and offer a higher price on almost every single deal that we look at to the seller. And the investor is going to have more information, and I know this for a fact right now, than literally anybody else in the industry out there. That's what we provide. When a seller submits a property to Simply, they go onto our website and they end up hitting what we call the offer engine. It's a machine learning based underwriting platform that evaluates 245 different pieces of data in real time. The 4 to 6 days it can take to underwrite even just a small SFR, we're doing in about 30 seconds. And that seller's going to get a response back immediately that says, yes, we're interested, or no, we're not. Occasionally, it might say we need more information. but every iteration of the system makes that happen less. If we're interested, what's actually happened at that point is we've not only analyzed the property, we've actually looked and said, what is the viability of this for a given strategy? And we've gone and compared it to our investor pool and said, who does this actually match up with that would more than likely have an interest? And depending on the investor, we have everyone from large PE companies or PE firms. We have some of the major turnkey operating platforms. And then we also have, we have a number of smaller mom and pop fix and flip guys all on there. We know immediately whether that property is going to work for them. And that starts the system running, because from then on, everything we're doing is done to operate empathetically and transparently. So we don't just make them an offer right off the bat. We send somebody out within 4 to 12 hours, depending on the day of the week. And we end up, grabbing photos and stuff. And that comes back. We have a team in-house of contractors led by my partner, Don, that are able to quickly evaluate that. If that passes the smell test, then we send somebody out to do a Matterport scan. When that scan comes back in, my valuations team throws on a virtual reality headset, and they walk through that property in VR, and they're able to actually mock up and Bobby's seen this. The level of detail that we are actually able to provide is not bathroom, $10,000 budget. There is a line item. If we're moving 10 square feet of tile out of a half bath, there is a line item for that 10 square feet to come up, and a line item for the 30 minutes is going to take an unskilled laborer to bring that out to the dumpster. Because if we don't have that level of transparency on our side and that level of detail, we don't know if our offer is fair. And at the same time, the seller needs to know how we got to what we're offering, and the investor needs to know what they should be expecting. So at the end of the day, when we go to our seller and we make them an offer, we are able to walk them through from the ARV down to our offer, exactly how we arrive at our price. And we offer them, say, listen, if you want to go talk to somebody else, go for it. We also have no problem telling somebody that we're not the right fit for them. It happens. Not every home is going to be a fit for us. And we're not looking to try to just get every deal done. We only want to do the deals that we have high confidence that either we're going to have to close on, or we can move on to an investor. For our investors, they have access to what we call the Simply Marketplace. And I invite all of you guys to sign up for this. You go to marketplace.selltosimply.com. You can click the button, join the wait list. We hand onboard everybody in. But what an investor gets in the marketplace is they get all of the information that we have. So they have full write-ups and research on the property itself. They have access to the 3D scans, access to the photos, access to our repair estimates, access to the third-party inspections that we do. They have detailed, and when I say detailed, I mean everything that we can collect on that property, we're going to show them. We run multiple AVM models, and we also explain why these models might not always line up. We provide 4 different condition-based AVMs as well, in a poor, average, great, and excellent condition. And then we also provide another 200 or so data points on the neighborhood this property is located in, covering everything from the average commute time to income to family makeup, to right down to how many houses are vacant, rented, or owner occupied, and how many of them have kids or roommates. We've tried to create a platform here that is exactly what we would want when we're doing our own investments. And we've brought this up and we've made it in a way that we believe we are going to transform the way that this often very unsexy part of the industry operates, with better transparency, with better clarity, and most of all, more empathy. And that's because these sellers very often are in a situation that, even though they may have created it, it's really uncomfortable. We talk a lot about our personas that we have, and we break them down to Grandpa Joe and Grandma Jane. These are the people that we deal with that are just like my mother-in-law, good people. There's probably a family member in there, and this is really a motivation that has more to do with a life change than finances. We have Kevin and Carrie, who are probably early 40s. We describe them as financially irresponsible and fiscally selfish. And then we have what we call contentious Karen, no offense to anybody named Karen in the room, who is dead set convinced that Zillow is the right price for them, even though their house has giant holes in the wall and the roof hasn't been replaced in 25 years. Every one of these people are still people first, and we make sure that we treat them like that. We make sure that that they are always treated with the respect they deserve, just as if they were our own family. And for our investors, we build the same level of relationship with transparency, speed, and efficiency. We're able to do every one of our closings fully remote, fully virtual, even in states and counties that require wet signature. This is the way that we believe in the next 3 to 5 years, you are going to see the industry when it comes to outdated and damaged homes going. And we believe that we are poised right now to lead this charge because we've built this from the ground up to be what is needed, not just what is convenient for the person that's middling the deal. So that's me in a nutshell, and that's what we're building, and we're pretty excited about it.
Thank you, Brian. I love everything you
Bobby,
said.
I can't hear you.
Oh, I'm on Zoom, Brian, so you may have to hear me on Zoom.
I can't hear you.
Can you turn up your Zoom volume?
Say it again.
Can you turn up your Zoom volume? Let's see. Can others hear me? Jason, can you hear me?
Yeah, I hear you.
Okay, I think because we're simulcasting, there's a little technical issue there, but Brian, can you hear me now?
Yeah.
Oh, thank you. So real quick, I've known Brian for a while. I love his business model. Both of us, there's some good wholesalers, there's some bad wholesalers. It's a mixed bag. Just like there's good realtors, there's bad realtors.
Absolutely.
What Brian is doing, he's making it more quantifiable, right? I don't have to guess. Like today, I went to look at a property. What the description was in the wholesaler's email to the actual property, totally different. So I have to go back. I have to reanalyze my numbers. I have to look at the comps again. I have to look at the, so Brian's doing all that work for you. His system is doing all that work for you. So I think there's some real value here, Brian. So we'll definitely come back and talk more about your model. And I want to see it grow in other markets. In my own case, and I can dive into this some more, right? I got royally screwed by a wholesaler to the point where I couldn't buy any more properties in that city. Anyway, long story short, I exited that market, went to a different market. But there's like I said, there's good wholesalers as well, and I was able to work with a different wholesaler in a different market. But anyway, we'll leave that for later. I know a couple of folks have joined on the East Coast. I want to respect everybody. We'll go with. Hey, good evening, Andrew, Bobby Sharma, Jason here. Thanks for joining us. I don't know if you can hear us or if you can introduce your company and yourself. Andrew Farah of Density.io. You may have to unmute yourself. Actually, I'll unmute you. Let me see. Andrew, if you can hear me, there's a little on the bottom left, there's a little mic icon. You just have to unmute yourself.
I'm gonna drop out of the clubhouse just because I think
I know. Yeah, there's cross audio. So thank you, Andrew. Thanks for joining. Excited to have you here. Tell us a little bit about yourself and tell us about Density.io and what you're working on. I think you guys have something phenomenal, very exciting. But share what Density.io is all about with our real estate PropTech audience over here.
Sure. My name is Andrew Farah. I'm co-founder and CEO of a company called Density. We build a system that essentially turns physical spaces into analytics. And what that means is that we count humans in space. We build both the sensors and the software that measure how these spaces are being used, and we get deployed into a lot of different space types. But we often work with a lot of organizations that are typically workplace. So you can imagine, tens of millions, hundreds of millions of square feet of space that is like largely unmeasured. Usually you'll do a space study, an architecture grad student with a clipboard will wander by and do what's called a bed check and sort of observe a space and make a note and then turn that into a 7 to 10 page space study, charge, $987,000 to a large corporate and then and then sort of deliver this PDF. And then typically hundreds of millions, billions of dollars of decisions get made around real estate portfolio and strategy from this document. And so we do something very straightforward, which is we try to measure all that square footage and then turn that data into actual utilization and analytics. And yeah, it's kind of crazy how much space we've built without knowing how it gets used. That is the state of the art, is to guess. I'm happy to sort of continue speaking on density, but
you got 10 minutes to tell us about density and about yourself. And
oh, full 10 minutes. Okay. All right. Well, 10 minutes. In that case, well, I guess 9 minutes and 8. Yeah. So, you know, we have been building buildings for thousands of years without knowing how they get used. And that's insane. Like, did you know that we clean rooms that are clean all around the world? It's approximately 40% of rooms get cleaned, sometimes multiple times, often multiple times a day, that have not been used. I think there's a definition of madness that is something like you do the same thing over and over again, expecting a different result. You know, I'm reasonably convinced that if New York City knew how it was used, it would design itself differently.
Yeah.
So the question is, like, can you figure out how to get an intelligent system that understands human behavior, that doesn't invade privacy? And I mean anonymous at source, by the way. We don't build cameras, we build systems that are anonymous at source. That understands how all of this relevant space is used so that you can feed that back into design decisions. There's no reason why A/B testing physical space shouldn't look a lot like A/B testing digital space. The only difference is whether or not you've measured and have a baseline on how space is actually being used. So we work with typically large corporates, often multinationals, and we design 2 pieces of hardware. One is an entry-based sensor that gets mounted above a point of entry, kind of like a nicely designed shower head. My head of marketing will hate me for saying that, but it is like a nicely designed shower head. It looks like an Apple TV, sort of about the size of an Apple TV, and it uses infrared laser light to bounce light off of objects as they're walking underneath. And then we measure the height values, you know, millions of these height values, and then produce +1, -1 at the points of entry. And then the second device is an open area device. It's a radar-based system that gets mounted kind of like a wireless access point. Mm-hmm. And we also calculate depth from this radar-based system, and we can measure any unbounded space. So I can't say who, but companies that you know and perhaps work for are going from like 95% assigned seating to 90% unassigned seating as people reopen. That means, like, you know, the photos of your family, you know, I have a 9-month-old baby girl named Josephine. You know, Josephine, the photo is going to be digital now, you know, as opposed to being on my desk, and it's going to be in a locker that I might bring out, and I'll be able to reserve a space, or I'll be able to just show up to a space. And the thing that's really interesting about that is that space is starting to look a bit more like a hotel, and a little bit less like, a bit more around hospitality, and a lot less like this is my space, my desk. Instead, all of the space is your space. Yeah. And you can choose to go wherever there is availability or wherever it is that you may have reserved space. And that's extremely exciting. It's also massively disruptive to the traditional form of work. We can essentially, you know, we provide a system that will measure in real time whether or not that desk is in use or that space is in use, without knowing gender, age, or ethnicity. Bobby, keep me honest on time, so just interrupt me at any point. But does anybody see, you know, the Marauders map from Harry Potter? Mm-hmm. It's like the Marauders map from Harry Potter. Like, you get a floor plan, you upload your floor plan, and our sensors will show you humans wandering through space. And it looks like you're in, you know, it's like Dumbledore wandering around his office in Hogwarts. Like, it is so cool. You just don't know it's Dumbledore, right? Like, we don't know the person. There's this great like thing about, does, you know, art inform design or engineering, or does engineering inform art? And I think in this case, we're really excited. There's this fun little thing that, you know, in like a sci-fi film when a doctor's walking down a hallway and the lights are turning on as as she walks into the grid, you know, and then they're turning off behind her as she's like moving from grid to grid. That's not possible today. That's not possible.
Yeah.
It looks easy. It looks easy. It is not possible. And the reason it's not possible is because the way that most dynamic lighting systems work is based on motion. And that motion is usually a timer with a passive infrared sensor that sits in, you know, a light fixture or up on a ceiling. And as people walk beneath it, it kicks on the lights. You ever been in that circumstance where, you know, the lights turn off and you wave your arms and then all of a sudden they turn back on?
Yeah.
So we're moving into a future in which turning off the light as you move to the next grid in real time, super low latency, will become possible. And so I think the thing that I'm most excited about is there isn't a future in which buildings continue to get built and used by humans, where humans don't eventually figure out how they're used. That future doesn't exist. It's just a question of with what technology.
Yep.
And is that pervasive camera-based facial recognition? Or is that like something that is invasive of privacy or requires a major privacy trade-off?
Yep.
Or is that with something that sort of preserves privacy? And is that commodity technology or is that advanced sort of computing? And I'm convinced that the concept of sensors is a oversimplification of what's actually necessary to measure space. People are weird. They just do stuff you wouldn't expect in space. They bump into each other, they take phone calls, they bring boxes and bicycles and bags and all sorts of other stuff with them. And yeah, I'm extremely excited for the future of physical space. I think that it's going to look a lot more like digital, and I think that it's going to look a lot more like a very high-end hotel, at least in certain space types. And if you can figure out how to get it right, there's no reason why you can't kind of reshape the built world once you understand how it's used.
Love it, love it. And Andrew, I'm assuming along with lighting, you can also control the air conditioning and the temperature, right? Maybe when there's more people in the building versus when there's much fewer people in the building, you can control the HVAC systems as well.
Yeah, and that was a oversimplified sort of example. Most of the organizations that we work with are essentially looking to try to benchmark how their office or building is being used next to all of their other buildings or offices. So we sort of call them portfolio admins or workplace admins. A portfolio admin will be running a portfolio, say 10, 15, 25 million square feet of space. It's impossible to make real estate decisions across 12 countries through observational studies or observational data. And so that anecdotal data is what drives the vast majority of real estate design and real estate decisions, buy or lease. So most of what we provide and power is, you know, you can spend $37,000 with us and we saved one client $5 million in lease avoidance because they realized that they had excess space in an office that they could add more folks to, and they could avoid the office that was next door that they didn't need. Yeah. Similarly, you know, knowing that a space has been reserved but is not in use is very useful because you can release the space. I think that, you know, the energy stuff and the automation and building automation, those are all really interesting things, but I'm, you know, yesterday, the world built 13,370 buildings. Sorry, 11,370 buildings. Today, it built 11,370 buildings. Tomorrow, it will build 11,370 buildings, net new. By 2030, that number is going to be closer to 14,000 new buildings each day. When that customer decides to avoid a lease that they don't need, that means that property remains on the market for somebody else to take over, which means whatever property they were going to take over also remains on the market. And then downstream, this has this positive consequence on the actual number of physical space or physical buildings you need. And I think that that's really consequential. I think that the squeezing out more efficient energy is actually, most of the systems today are pretty good. Like smart energy is actually pretty good. You want to return $250 billion back to the US federal government, reduce its real estate by 40%. The 40% it's definitely not using, by the way. Like and it's not just, it's not just like we're not in the building because of the pandemic. I'm saying pre-pandemic in the US, there's 10.9 billion square feet of leased or owned office space. 41% of it is vacant but paid for. meaning occupied,
Okay.
leased, owned, used, but it's the floor that's not touched or the room that's not touched. It's worth $1 trillion, just the space that we're not using. And so I often get labeled as like the space waste guy, but I'm not actually making that point. I don't know that it matters that you decide to waste space. I think what matters is that you don't know that you're wasting space. It's like at least know and make a conscious decision that you are at 1,975 square feet per employee. You know, make that a conscious choice as opposed to living with the consequence of poor utilization. And vice versa. There's another side of this bell curve, which is like 128% utilization, 196% utilization. How can we sort of load balance the space so that humans are more productive, enjoy space a bit better, can find the thing that they need, don't run into crowding unless they want it. That is a future that's coming, and it's extremely exciting.
Yeah, I love it. I think you're right on. I think I personally, having worked in both downtown Los Angeles and downtown San Francisco, I know how much wasted space there is, especially in the office arena. There's just the high-rise office spaces and so on. But companies, they're stuck. They signed this 5-year or 10-year lease, and they're in it for the long haul. But it's very hard for them to make those decisions until they have your data. A quick question for you, Andrew. How do you go to market? Who are your ideal customers? Is it the corporation that has signed the lease, or is it the building owners? Like who are your customers?
So the vast majority of our customers are the end occupants. So we work with the multinationals that either own the building or are leasing space. And then they deploy our technology into their space. It's interesting, owners, and we may have some owners on this call today, but owners fall into one of two categories. And they will willingly admit this, by the way. It's fascinating. Yeah. Half will say, honestly, like, I don't really want to know. I don't want my tenants to know, because then they won't buy more space. They're not economically incentivized to measure a waste of space. And then the other half accepts this as an inevitability. And depending on which category you fall into, you may or may not really care about utilization. What I think is probably going to end up happening for owners is that it'll become, there will be a standard platform for measuring space. Kind of like there are standards today around either LEED or standards around particular types of building structures, and they get adopted as a part of marketing, meaning like this building already has this type of access control, touchless access control. This building already has this type of security. I think that will probably happen with measurement, where it's like, is this building already outfitted with, is it aware of the humans, or is it not aware of the humans? Because if it's not aware of the humans, I'm going to go use a building that's aware of the humans, because my return on investment is substantially more. I mean, we're talking real estate is the second most expensive thing next to payroll. And there are not many multi-trillion-dollar markets, and real estate's one of them. And it is extremely, whoever figures out how to find the remnant inventory in that people don't know about, and strip that out or redeploy it or whatever else, I think is going to, these teams, if you are an owner, just know that the teams that you're advising and working with are starting to understand their buildings and are going to show up with data that didn't exist before. And it's not just us. I have all of these opinions and take them with a grain of salt, but like, there are a lot of providers in the space, and I would say we're just one of them. And but they're showing up with data, and they're going to say, hey, look, like my utilization's at 12%. We're not leasing this space again. We're going to let it expire. But I'm at 122% over here, and I want to grow there, even though I know that the cost per square foot is substantially lower. And that obviously eats into P to value ratios during your quarterly business review with whoever the provider may be. But and so I think savvy owners will probably start to deploy it themselves, and I think the advisory and brokerage teams in between, the ones that are sort of advising strategy, are starting to become really savvy about data.
I totally agree. also, I mean, I know you started the company pre-COVID. So, I mean, you had this idea going way before COVID, but what has COVID, what kind of data have you been able to uncover now that people are more open to working from home? Is in the future, let's say post-COVID, I know a lot of executives, you know, Mark Benioff and Jack Dorsey and a lot of, you know, well-known CEOs have said, listen, it's going to be different. It's going to be a hybrid model, people working from home. So I totally agree with you on the hotel kind of setup for utilization and when you're in the office. But what other, I mean, if you're a commercial office space building owner, you're worried about you know, what happens to your people that are leasing the space from you, their utilization, because now they want a smaller footprint. And then you have the data coming from density, sharing like the details of that, you know, that over too much space. So how are building owners kind of reacting to this? Or, you know, can you tell us, is there a little panic in that space, or what is the current state of commercial office space owners? Yeah.
I mean, there are way better experts to answer that question than me. So I'm going to tell you from our perspective alone. It seems, and we have hundreds of corporate clients. So we work with some of the largest brands in the world. They tend to have tens of millions, hundreds of millions of square feet of space. Like they're running big portfolios. And then we also work with sort of the mid-market. So these are fast growing 1,000+ employees. They're the enterprise companies of tomorrow. You know, so anyway, those tend to be our segments, mid-market and enterprise. And one of the things that was really interesting, I'm sorry, you may hear some sirens here in San Francisco. Yeah, maybe I mute just for 1 second.
Sure.
All right, so everyone kind of is waiting. So pandemic hit and like everybody went home. I mean, we work with airlines and hotels and offices, and we watched an airline go from 87% week over week drop in foot traffic when the pandemic hit. And it was staggering. I'd never seen anything like it. I mean, we obviously never seen anything like it. But everybody went home. Utilization rates dropped to below 1% across the board for almost all corporate clients. Now, what's really interesting is about 48% of the US population all of last year was still going into work. You know, we talk about remote work, but there's a huge portion of the population whose working lives are required to be in a physical space. And I don't mean just knowledge workers. I mean, you know, with demanding bosses, I mean like people that are serving coffee and like doing construction and whatnot. So anyway, for the folks that could go home and work, went home, utilization dropped below 1%. Pandemic sort of largely has started to pass and people are returning to office. And I want to qualify this as return to office, not return to work. People continued to work, if not more than they ever have during the pandemic. Come back to office and utilization rates are, you know, 8%, 18%, 28%, you know, not always ending in 8, but they're returning in a staggered fashion. And so it's more each month or it's more each quarter. I think what we're probably going to end up seeing, you know, peak utilization for some accounts was, you know, 39% pre-pandemic.
Yeah.
So those folks, I would expect those numbers to have, meaning their real estate's going to be, call it 80, 82%, 83% vacant.
Yeah.
And I think that's been the biggest shift in the industry, where the excess is now obvious.
Yeah.
And heads of real estate and workplace teams are getting asked by their CFOs, hey, how much space are we going to actually need when people come back if we're in a hybrid model? Yeah. And the answer is, I don't really know. I mean, we have some interesting data, but I'm not entirely sure yet. I just know that everybody was wasting it prior. The vast majority of the industry was wasting it prior. What's going to happen going forward is 30-40% of the workforce may be in each day, and then you're going to see a gradual decline or drop off. And hybrid is the most likely permanent future. A couple days in office each day or each week, maybe bookend Monday, Friday, you're working from home. But in a hybrid future, measuring utilization, there's sort of an inverse correlation between the demand for the type of services that we provide. And I say this as unbiased as possible. The fewer people in a building, the higher the demand for measurement, because the excess is now obvious, whereas before it was easy to sort of hide the excess behind, well, it feels busy. I think we're going to see by mid-summer next year, spring next year, leases are going to come due, and the market's going to be flooded with lease expirations. So there's 9 million square feet of sublease available in San Francisco, and that is the small stuff. Like the big stuff is coming.
Yeah, totally agree. No, this is a real problem, and I think we're going to see some tectonic shifts in this space. So Andrew, thank you so much. I know people have a lot of questions. I probably got another 2 hours of questions, but I'm gonna save them for another day. But thank you so much. And what we'll do real quick, we're doing 10-minute introductions, and then we'll come back with a little Q&A. But I've got 2 other wonderful speakers. One is Trevor Barran. If you are around, Trevor, if you can unmute yourself and tell us a little bit about yourself and your company, Lionheart Acquisitions. If not, let me see, Trevor might be multitasking. Otherwise, we'll go to Khalil. Okay.
No, I'm here, Bobby. Can you hear me?
Hey, Trevor. Thank you so much.
Great.
I don't know if you can, if your camera's on or not, but if you want, it's totally up to you.
Yeah, I don't have camera with me right now, but thanks for inviting me here, and good afternoon, good evening, everyone. Really interesting conversation, and it was wonderful to hear about Brian and Andrew's businesses. My background is in technology, actually, aerospace engineering and computer science. And my sort of lead up to real estate was a few decades in various different industries, such as medical devices, high frequency trading, AI, evolutionary computation, stuff like that. And my first foray into real estate was actually in hospitality. So a lot of the subjects that we were just talking about relating to how, or hearing about relating to how hospitality and the ideas of hospitality are kind of being pushed through as change agents into many different asset classes of real estate is something that I'm attuned to and quite interested in. So as Lionheart Capital is a New York City and South Florida based developer of a number of different types of assets, including high-end luxury residential, such as the Ritz-Carltons. We have a couple of those in South Florida, as well as destination resorts. And most recently, about 5 years ago, I co-founded and now run a shopping mall portfolio called Out of the Box Ventures, where we're buying up malls across the country. Wow. So we're up to about 7 million square foot, and a lot of the subjects of analyzing traffic flow, people movement, density, how to redo retail using hospitality inspired entertainment, and actually even co-working that's coming into more localized former retail zones, but is now made available to local communities who now don't have to or need to, even before COVID, commute into their local downtown center. Those are all some of the use cases that are coming into play. Anyhow, with a background in technology and also in real estate development and operations, I got into the world of SPACs a couple years ago, and our first SPAC, actually came to us in an interesting way. Our shopping mall portfolio out of the box ventures was the notional target of a SPAC. And in probably an unusual execution, we decided ultimately not to proceed with the merger and take out of the box public via the SPAC vehicle, but we bought the vehicle and then used it to execute a subsequent merger with a quick service restaurant chain, BurgerFi. And we learned quite a fair amount quickly about what is also a relatively dynamic market space, the SPAC market space, and launched our own SPAC vehicle called Lionheart Capital Acquisition Corp II, which is a $230 million SPAC focused on the PropTech space. So I've been having just a wonderful time meeting amazing companies and entrepreneurs like Andrew and Brian and hundreds of others in what I think is one of the most underfunded spaces, actually, compared to the amount of opportunity in real estate. The potential disruption that applying even very proven technology models kind of into this relatively laggard asset class, I think has a huge amount of upside. So that's what we're doing in a nutshell. I could go deeper into some other sort of adjacencies and interesting opportunities. Maybe I'll just mention one. The idea of how the virtual world relates to the physical world of real estate is a subject that I'm very inquisitive about and very passionate about. And I have to deal with this subject quite often as we're reimagining what happens inside of that, former department store, what happens inside of this empty box. And applying hospitality thinking to it, you kind of come to realize you need to plug into a few different communities in order to reactivate space. One is your local community that physically surrounds that, but the other, of course, is a sort of higher dimensional virtual community that may or may not be directly inside of that surrounding physicality, but it relates to it. And there's kind of a really big wave of a movement, I'd really call it, of how physical and virtual communities are coming together. One incarnation of them is esports. Another one is what I would just call generally interactive entertainment or gamification of experience. And we've actually put together a number of concepts that we kind of enjoy the incubation ecosystem of our own portfolio of 7 million square foot to try things out in and test out in local communities and fine tune. But we're just about to launch a venture capital fund that is related to investing in esports and interactive entertainment, but with the sort of protrusion from the virtual world into the physical world. So I'm pretty excited about that. That's Cloud Tree Ventures. That'll be launching into market in a few weeks. And therein, there's some really interesting new things coming out, such as, the traveling Van Gogh, like virtual exhibit that I actually just went to a couple of days ago in New York City, or, art collectives like Meow Wolf who are looking to do interesting things in retail space across the country. Really interesting esports production brands like SubNation that are looking to produce things out of physical space with local communities that then push back out and create new revenue streams. So I'm quite interested in this this sort of next frontier, but I'll just pause there because I can go far down the rabbit hole.
Wow. Amazing, Trevor. How do you have time for all this? That's amazing.
Kind of all related.
Yeah, sure. I know. It's wonderful, wonderful. I do have a question about our audience would like to know what I just learned about what a SPAC is. I had to dig into it, but for the layman, walking down Main Street, what exactly is a SPAC, and who does it help? In a nutshell, if you could share what that is with our audience.
Sure. A SPAC definitionally is a special purpose acquisition company. It's a company that has the special purpose of living to combine some cash that is raised at the beginning of its lifetime with a private company, and the end result being a public company.
Yep.
So it is kind of an alternate mechanism for an IPO. Before a few years ago, most private companies that reach the size, scale, or other dimensions that make them want to be public, they would follow this IPO process whereby they'd find a banker, they'd price it, they'd take it to market. Some insiders would get in early, the rest of the public market would get in later, lots of news releases, whatever, go public. A SPAC is substantially similar, except that there is a shell company that has only a team and a bank account, and there's an IPO event at the beginning of the SPAC where money is raised by the team against their thesis. So, in the case of our SPAC Lionheart Capital, there's a founding team of a few different people, of which I'm one. And we do a roadshow and raise capital behind the idea that I just articulated, that technology can have a disproportionate impact on real estate. And there's a number of interesting target companies. And so we raised $230 million of cash to then combine with one or more companies in that space. Very typically, the end result of a SPAC business combination is one private company getting capitalized, not many, because doing a multiple way merger is, in a practical sense, quite a bit more complicated than doing a merger with one company seeking, say, $200-ish million of cash in order to get to its next stage. The world of SPACs has been kind of a combination of soap opera and fanfare. So I think before 2 years ago, a SPAC was regarded as a second class type of financial product or mechanism for companies to go public. I really think that Richard Branson with Virgin Galactic was the one who opened up the playing field, and people said, well, if it's good enough for Richard, it's good enough for my company. And suddenly there was this kind of rush to get to market via SPAC mergers, they're called. A SPAC is kind of a fair weather market product. So generally companies want to go public while the going's good, and we're in a very hot market. So the market's very receptive for private to public transitions. And so SPACs have enjoyed sort of order of magnitude growth within the last couple of years, both in terms of number of SPACs IPOing and total capital out there that is seeking deals with private companies. I think we're like over 400 SPACs on the market with north of a few $1 billion kind of hunting for private deals, private companies to combine with that will result in a now capitalized public company. So that's kind of what a SPAC is.
Amazing. A genius way of going public faster, maybe with less. From what I understand, the company such as a Lionheart would do all the SEC filings. They would have everything ready to go, and then the private company would come in and go IPO through that process. It's a faster process. Because I remember, before I had to, you had to go to Goldman Sachs and kind of beg them to take you on and do the roadshow and everything to raise capital. But I think this is a very efficient way of doing it. So thank you, Trevor. I do have
just to cover off
Absolutely.
on your explicit question there. I think there's probably three major advantages for private companies seeking to do a de-SPAC versus an IPO. The first, as you mentioned, can be time, though honestly, I think it can be time on the short end. Let's say the minimum time frame to realistically execute a SPAC transaction, if all the financials are in the right shape and everything's ready and the management team's in place and all that, is probably about 3 months. And the minimum time frame realistically to execute an IPO from zero is probably more in the order of like 12 to 18 months. So there is that potential time advantage. In reality, I think the average sort of first combination to de-SPAC is probably more like 6 to 12 months anyway, partly because it takes a while to get things in order, and partly because there is a timing to when the right moment is to take any given company public. So time is a factor, though, you're right. The second, I would say, is management of the flow of information. So a good counterexample to this is WeWork. So when WeWork completely botched the IPO, or WeWork plus its bankers botched the IPO, and we saw it drop from like 65 billion to whatever, a few billion. I would argue that a major part of both the disconnect that created that cliff, as well as the market reactions to it, are because the flow of information is a little bit more, it's a little bit more of a commitment with an IPO, because you kind of pre-sell a bunch of investors on a certain valuation, there's an announcement, it's coming to market, and you're kind of committed to the transaction from the company's perspective and the banker's perspective, and there are less opportunities to sound out valuation and to feel out investor intent than there are in a SPAC. In a SPAC, before you decide, before everyone really commits to this transaction, there are a few ways of testing the waters, and that's what we call it. There's testing the waters meetings, literally, where you can take a candidate transaction to your set of SPAC investors and other experts in the field of interest or the specific target sector, and get them to opine on valuation, and they'll tell you if they think it's a good valuation or not. So you're less likely to have a vast disconnect the way that we had with WeWork. Secondly, you can pre-gauge market sentiment, because you can announce a transaction before actually committing to it. So you can say SPAC XYZ has the intention of combining with Density.io, and the market will, because the vehicle is already public, the market can react to that news and like it or not like it by buying or selling the shares of the SPAC. So again, before going through with it, before like sort of full commitments, you get a chance to gauge public market reaction. And I think the management of information is one of the best tools of the SPAC. The third is simply who's taking the risk. So in a SPAC transaction, someone has to pay bankers and lawyers to get all this stuff done. In a SPAC transaction, the SPAC sponsors are doing it. In an IPO, the company has to sort of line up, say, 5 to 10 million of capital and a bunch of time and energy, and start committing to that road kind of 12 to 18 months in advance. In my experience, hot companies that are sort of ready to go public in this environment are often great management teams with their heads down, building their businesses, and they sort of pop their head up one day and say, oh my God, this would be a great moment to go public. But if the clock is starting then they're going to have to sort of work 12 to 18 months longer. And we are in an interesting zone here where there are plenty of interesting, like great companies, honestly, who have been building their businesses based on fundamentals and haven't really been thinking about that public transition. But because the public markets are hot, it makes sense.
Makes a lot of sense. Excellent, Trevor. Amazing portfolio, amazing ideas. Love what you're doing with esports, and thank you so much. I'm sure we'll come back from the audience with a lot of questions, but and I've got many myself, but we'll go to Khalil. Khalil's been waiting patiently in Vancouver, Canada. And Khalil, welcome, and tell us a little bit about your startup, and you can, if you want, you can demo your product. We're all ears.
I would love to. Hey, everybody. Can you hear me okay?
Yes.
Awesome. I'm gonna pretend like I know what a SPAC is, but that guy's so smart. I still have no idea. So I'll just pretend like I know what I'm doing here. My name is Khalil Ashante. I'm the founder and CEO of Mantis XR. And the story that I wanted to share with you was the possibility that immersive experiences could be shared online through a URL from any device. It all started when I was performing magic in Japanese at Caesar's Palace for 3 years. We'll save that for another call. But what I realized, and I'm talking about the old Vegas, 97 Vegas. I know I got some amens out there. But basically, my walk to work as a performer was through the forum shops at Caesar's Palace, which was one of the most expensive but successful shopping experiences of its kind. Per square foot, it was one of the most successful in the world. And that's when I realized that luxury brands and luxury purchases sell the experience. And that's how we ended up where we are today, with creating these experiences for luxury real estate. So at Mantis XR, we create immersive, photorealistic experiences from floor plans that have chat, Shopify, and streaming all layered in. So Bobby wanted to look at a condo in Vancouver where it costs like $30 for an apple. Don't move here. But if you did, you want to check out this condo before it's built, before the presentation center is even built. The realtor, the developer, could get ahead on sales and be able to actually invite Bobby through a URL on his phone to one of our experiences. And then Bobby could invite Wendy, Jason, and Jimmy, and they could all tour through this experience from the comfort of their device. No more isolated 360, experiences. I don't understand that economy very well. I don't want to walk around in a building by myself. I can do that without COVID. So it occurred to me as I was performing at Caesars and walking by these expensive shops that it's a very emotional experience to make a really, really big purchase. We were founded in 2020 in August, and we have a team of 6, and we specialize in something called ray tracing technology. So we take the floor plan, you upload it to our servers, and then we basically take whatever makes the Avengers movies look so real, and we apply that to your property. So if you have a block of condos that you'd like to sell, you can sell them before a brick is laid. You can get approvals from authorities before any of it's built, rather than just sending them floor plans. And it's the only one on the market that allows you to actually make changes to the actual environment. Once you've done that with a pre-built 360, you can't change anything. And the only constant in our world is change. So we have paying customers in the winery and auto space, as well as under NDA with 2 Premier League football teams and a luxury automaker in Europe. We came to the real estate market through them going, you know what, you should really try real estate. So we're admittedly early, but we're raising 1.5 million in a seed round because we see this as a huge opportunity, especially in Japan, where I spent most of my childhood till age 11, as well as an opportunity to raise this money to be able to build a more turnkey solution. So it would basically be more of like the Shopify of the web XR world. Wanted to just close by saying, I think it should be available to everybody. WebXR, that's really what we're about. And phase 2 is to take this and open source it. So anyone who wants to create immersive experiences can use our proprietary technology to do so. I have nothing against people using VR goggles, but I do believe that there's a whole demographic of the world who's not going to be able to drop $299 on goggles. People need groceries, baby needs diapers, and mama needs shoes. So my name is Khalil. Thanks for allowing me to share, and I'd love to answer any questions.
Awesome. Thank you, Khalil. I'm so curious. At some point, I want to see a live demo of a luxury real estate property in Vancouver. Only Brian and Andrew and Trevor can probably afford it, but I'm so, but yes. Do you want to do a quick demo, Khalil, or not?
I'd love to. For anybody listening on Clubhouse, actually in my Clubhouse bio, there is a link that you can go to on your phone. It's much better on your phone. I'm happy to do a demo here. I'll also put the link in the chat to everyone if you'd like to visit this link on your phone. Allow access to motion sensors, please. But I'm going to share my screen as well for those of you who want to see it here. So give me 1 second. And this is a mobile office. As you can see, we have the chat turned on.
and you can minimize the chat up here. We also have the native streaming. I'm a JavaScript developer as well. Went to coding school between tucking in the boys, helping my wife with dishes, and trying to be a good dad. But this is something I'm really passionate about, and we have a great team building this stuff. We have a design team, but nothing you see here actually exists in real life. We can create this from two-dimensional photos or Revit files or CAD files. You can see Homer there, that's the dog. But this experience actually uses the motion sensors on your device so that you actually get the feel and the emotion of the space. And we have actually, this is actually version 1. Version 2 is a lot more slick with these hot spots that can be labeled. You can have points of interest for video. Again, Bobby Sharma can be up here selling it to you, saying, hey, look in the kitchen and look in the bathroom. And you can go in the bathroom and you can click on this if you want to buy the sink. We've actually made it incredibly immersive. And we have several experiences like this. An auto dealership, we have Canada's first virtual wine tasting room. Wow. So I feel like real estate has always sort of been our sort of beachhead. Yeah. And with a background like mine in performing and bringing people together in odd spaces, this is something that I really enjoy doing. Also, we also do exteriors, so I'll take you outside here to the backyard, and you can sort of see the grass and all of this. So this is what we're excited about. And yeah, any questions?
Yeah, Khalil, a very obvious question. I know, and this is a softball. Matterport does something like this. What's your differentiator?
Yes, Matterport, they take you on a 360. So for instance, their new mobile app, which is great. You can only do it with one room, right? And you don't have chat, you don't have streaming, and you can't change anything. So we feel like whereas Matterport and a lot of these awesome companies are doing something great with, somebody's got to go in with a 360 camera and a tripod. Yeah. I'm impatient. So yeah. I'm thinking of the people who might have a floor plan. It's not built yet. And now you can walk through it like this in a context with this new WebXR API that has been released in 2020 that we're pushing to the limit.
That's brilliant. And then Khalil, for you to render those pictures, just what kind of camera, like an ordinary phone or what kind of camera?
No. Well, from a 2D photo, it's whatever you have. Usually it's an iPhone, but we actually work from floor plans. Like for instance, the winery we built in the Okanagan, which is the Canadian version of Napa Valley, was from Pinterest photos.
Okay.
So our tool, you don't actually need a camera. You just need a floor plan.
That's brilliant.
Khalil.
Brilliant.
Bobby, can I ask
Absolutely, Brian.
Khalil, so that's WebXR. So if I actually threw on my headset, that should pick up as a full VR experience, right?
That is correct. So what we've done with customers so far, Brian, is we can up the actual resolution so that it looks great on your Oculus Quest or whatever you're using. But yeah, as of today, you can definitely do that with a VR headset. The demos that we have for online aren't the best optimized for that, but that's actually correct.
And then if I had an existing point cloud, let's say of an existing building, can you selectively drop in the updates or renovations?
Absolutely. Yeah. I mean, hopefully, assuming you can get them to us in a timely manner. Absolutely.
We should talk offline.
Yeah. You guys need to connect
for two reasons. One, a fund that I scout for. Two, I don't know if you're looking to raise capital, but two, this is really cool.
Oh, thank you. Yeah, I'd be happy to talk offline.
Awesome, Khalil. Hey, folks, listen. We had Andrew, we had Trevor, we had Brian, we had Khalil. Please unmute yourself and ask your questions. And go ahead or you can chat your questions, or Clubhouse folks can ask the questions, and Jason can relay them to us. But feel free to unmute yourself and ask. Don't be shy. If not, let me see. Let me see if anything came in through the chat. Let's see. Let's see here.
I got one.
Sure, go for it.
Khalil, I'm interested working in this space and that. What's the difference with your program compared to a lot of 3D modeling and some of the VR stuff that's being done out there? Like we have a lot of flexibility where we can change and upload all the floor plans, you talked about real estate. So take a production builder. So they have a different, 100 different options and can upload with a click, and then where somebody can walk through and click and see, 10 different floors, 20 different cabinets or finishes, other things. Just share with me a little bit what's the difference, because there might be an opportunity also with our company and what we're doing if there's a different play.
Yeah, there's a couple different software packet opportunities out there in this space. So one of them uses you can use Unreal Engine, you can use Unity, which is sort of when you have the color palette in the kitchen and you click it and all the kitchen cabinets turn to blue or yellow or red. Performance wise, those are a heavy toll on the CPU. So our version of it is actually a lot easier to access. Much like Brian, I use my mom as an example. She can get on her Dell from whatever year and be fine with it. So that actually is something that is more of a higher enterprise value and a higher price, but is absolutely possible. But in terms of the actual experience, our experiences load actually 8 times faster because of that. So we definitely, obviously, like I said, we deal more in the pre-visualization, but can definitely accommodate those different changes. We just sort of do it in a more performant way.
Okay. Yeah, we'll talk maybe more offline.
Yeah, you guys should connect.
Yeah, I've got my email in the chat for everyone if you want to.
Yeah. And I have a question for Trevor. Trevor, what are you seeing? I know you bought up 7 million square feet of mall space. I'm assuming you got some good bargains over there, but what are you going to convert them into, or if anything, what are your plans to convert them into?
Sure. I think that the simplest way to answer it is about 20% of the properties want to have a higher purpose in life, not as a retail center, and the communities, the real estate itself, and the demand is such that there's going to be a heavier intervention. And so these end up being new hearts of city campuses that have multifamily and hotel and office components and healthcare systems, and kind of, think of it as a singular opportunity to be an urban planner in partnership with the mayor and the municipality on the only available 50 to 100 acre parcel of land inside of a populous area. So it's really an urban redevelopment project. The other 80% that's not their optimal execution. Their optimal execution is more of a reprogramming, and you're really trying to adaptively reuse the existing envelope of the building and never forget the parking field, which is another 50 to 100 acres. So in those instances, I'd say the optimal use is roughly split between healthcare, entertainment, particularly F&B driven entertainment. There's some opportunity for hospitality, like hotels, again, depending on demand, more of an out parcel kind of play. And then I'm a real big fan of education, youth sports, and co-working, again, market dependent. So you really have to think of these things as large scale urban redevelopment projects, whether you're doing any actual hard building or whether you're doing a reprogramming. The steps are kind of typical development steps, and your first stop is really plugging into the local community, seeing what's going on around, seeing what the real unmet needs and demand drivers are, and then getting very cozy with the municipality and sometimes the state, because the nice thing about this kind of retail turnover strategy is that the community both wants and needs success. And so you don't have the same kind of zoning headaches and issues, and it's really not a fight to kind of get the optimal plan if it's well thought through and tuned up to demand put through. There's often a lot of money available to kind of assist in the effort as well.
Love it, love it. I totally agree with everything you said, because yes, they're always in amazing locations, right? I mean, just the fact that somebody invested so much money to find that location.
Right. Yeah, like the average sort of in today's dollars build cost for, let's call it a 1 million square foot under roof on 100 acres of infrastructure is kind of 200 to 300 million bucks. So, you know, the original developers weren't idiots. They didn't take the task lightly. And very often, even if they were building into kind of cheap sort of real estate, kind of in the 1950s, 60s, 70s, and 80s, when a lot of these things were built, whole sort of de facto communities grew up around them. Because particularly in America, kind of much less so in other countries, but particularly in America, there really isn't a lot of infrastructure investment into community centers. In America, we have malls, not community centers. And so malls are the community center. This is sort of the opportunity for that real estate to come back and serve the community in a more ample and deeper way than just kind of buying clothes at a department store.
Yeah, very, very nice. Very nice. Thank you, Trevor. And folks, any other folks that are curious about Brian's company, that are curious about Khalil or Trevor? Trevor, one quick question for you. Your investors, who are they? Are they institutional or high net worth, or what's the profile of your investors?
It's a mixture of institutional and high net worth individuals, but one kind of fascinating characteristic of the investor base who's keyed into this strategy is that they're not American. So almost all of the capital is coming from outside the States. And a big part of the reason for this is that I think the bottom of the market was falsely called a few times, kind of 15 years ago, 10 years ago, even 5 years ago. And a lot of your usual suspect American source funds for this type of strategy have been burnt. And it's hard to go back to the well for more cash if you kind of flubbed it on the first go around. So interestingly, a lot of the cash for this is actually coming from outside the States.
Wow, very interesting, very interesting. Good to know, good to know. All right, and Brian, question for you. What's your expansion strategy? How are you looking to grow your company in different markets? And I know you started out in Maine and doing extremely well on the Northeast, but tell us a little bit about where you're headed next.
Yeah, so we're based in Maine, but our primary markets are actually not Maine, not New England. So we recently just launched into Houston, Indianapolis, Dayton, Cincinnati, and Columbus, Ohio, Louisville, Kentucky, and Little Rock, Arkansas. There's another 19 cities that we're launching into over the next 4 quarters or so. We have supply agreements with a couple of the really well-established turnkey and fractional rental operators. So what's happened is that a lot of these companies they're brilliant business models, but they highly optimized for their demand side, and their supply needs are actually our demand in the marketplace model. So yeah, so we just launched into Houston this week. And last week we pushed into those other markets, and it's crazy. We're already seeing some pretty strong traction, even just in the last couple of weeks. You know, for us, a big benefit is my background being in what's called applied meta systems and human process automation is really what has made a lot of this streamline and work, and we're leveraging every piece of tech that we can to make that happen. the next few quarters as we move towards our next round are going to be pretty exciting.
Love it. Love it. I think you're onto something very big, Brian. So if we can ever partner up on anything in California or South Florida, please let me know. But yeah, I think you pick some good markets, and there's definitely rental demand. There's definitely rehab demand in those markets. So turnkey properties, all of that makes a lot of sense.
Yeah, and I mean, for us, the beauty with us is, and again, you've seen this in the past, is that we really positioned ourselves that we want to set up our investors on the marketplace for success.
Yeah.
So that what you went through in that city doesn't happen.
Yeah.
And along the way, the sellers are also winning.
Yeah.
And that's what's going to drive the transformation of this space.
Yeah.
And what I have a frenemy that has been, and I have no problem with wholesalers. Technically we're a wholesaler, technically. But when I'm seeing Instagram posts of them having 40, 50, 60, 70, $80,000 spreads, we go in, we target $5,000 to $10,000 max.
Yeah. Yeah.
Everybody wins at our level. At the other level, a lot of people are losing.
It's a one-sided. It's a very one-sided game. So yeah, I totally agree with you. It's got to be a win for the seller and the buyer.
Yeah.
So
I agree.
I've got some stories that just make my stomach turn, but we'll save that for.
Well, yeah, and we'll see. We're going pretty heavy into that one city that you and I have discussed.
Yeah.
And our plan here, and the funds and VCs that backed us, that have looked at some of our competitors.
Yeah.
That exist. There's going to be a point where, if nothing else, and we're going to make money along the way doing this,
yeah,
we are going to force some of these operators to either close up shop, or their entire business model is going to have to radically change when we're there, and we're legitimately a better deal for everybody involved.
Yeah.
And that's the difference. That's what we're really driving towards, is transforming that.
Yeah, totally agree. Excellent.
And Brian, I had a question for you about your sort of optimal marketplace.
Yeah.
What is, do you think, going to be the ideal entry and exit point for an asset that's flowing through your system? I.e., what is someone probably going to be selling an asset for, kind of pre-conversion work, and then what are you modeling that in terms of the value they're at?
So we grade everything on a point system, and let's bucket that into the same process of how you might grade a used car. We look primarily for the homes that are not gut level renos, but not a whole lot better, right up to ones that basically need some spit and polish, but they're otherwise clean. On the lower end of that, and it's all a function of work to be done. We're usually coming in on those low level ones somewhere 20 to 40% of the after repair value. On the other extreme, the ones that are pretty much ready to go, we're probably going to be at 85 cents on the ARV dollar. I mean, it really depends on the property. What we're really looking for are people that they have decent equity. We won't look at a property that, for the most part, doesn't have at least 25 to 30% equity. And even at that level, it has to be a pretty clean property, because the numbers don't work. And that's the issue that we see a lot, is if somebody has already tapped out all the equity in the house, there's not much that can be done for them at that point. And we tell them that point blank. Because if the house needs 40 or 50 grand of work, and that end investor is going to be well into upside down when that work is done, nobody wins. And we don't get involved in short sales. So for us, what we're looking for is somebody that, regardless of how aware they are of what's going on, that they're willing to listen to logic as long as they're being treated in a very empathetic manner.
And in terms of the, let's call it the, there's sort of the amateur wannabe flipper, and then there's kind of pro shops that are doing this
Right.
at large scale, and then there's like sort of, let's call it prosumer in between.
Mm.
How big is the marketplace in the US of individual actors?
So there were 2019, $153 billion was the rough demand. 76.1 billion was the actual market flow through. It was about 11% of the overall existing home sales in 2019. The demand is 2 to 3 times what it is. So 153 to, let's call it 210 billion or so annually. Works out to between 500 and 750,000 homes a year that fall into this space. What doesn't come into that number are all of the homes where people never actually thought that they could sell them. They had a little bit more awareness of, my house doesn't look like the one that just sold down the street. And that is potentially another 100% of that number. It's a massive, massive market.
Cool. If you look at a company like Carvana, who obviously don't do the same thing as you do, but there are some analogies. And I love Carvana, by the way. I think it's such an interesting company. How much of the sort of intelligence behind the machine that you're building is like industry or asset type specific? And how much of it might get applied to other asset classes that are the types of asset classes that require further investment?
It's a really good question. Our model is a combination of 3 things. What we call decision trees, which are logical evaluation. Bayesian probability, i.e. the more we see of something, the more accurate we are at determining whether or not something is good, bad, or otherwise. And then finally, we use some actual what I consider true machine learning, true black box stuff to evaluate that. The beauty of that is, if we change the inputs and take just a little bit of time to do that, we can adapt something new in. It's why we're able to move into a new market inside of 30 days from when we say go. It's also why, like right now, there's a green building initiative that has reached out to us that they wanted to know if we can do a similar thing on land for them, and we can. And they've been told that. It's a matter of, it has to be worth our while to do that at that level. But the models are very adaptable. As long as we understand what we're evaluating on, it's easy to add in a new asset class.
That's pretty interesting. And what's your truth that you sort of retrain and relearn your model on? Are you just tracking the actual downstream sort of sales prices and then coming back and seeing how accurate things might have been? Or are you tracking how much investment dollars people put in against your recommendations?
Sort of. So from a pure analysis standpoint, what we end up looking at is are the data points that we can actually track against. So when we pull a property or it gets submitted in, there's 53 key data points that we try to evaluate against. But the reality is, we rarely can get more than about 2/3 of that. And so what we've done is we've figured out how to weight those on a given market. And then as we go forward, we are going to end up comparing that to the outcome. And so that's one side of it. The other side of it is, we found that there are indicators of where that house sits within its given neighborhood. Was there a zip or a zip +4? And the data that we have on that. So like, I'll give you an example. A really strong indicator of the end strategy of a property is the commute time for that zip code. So how long somebody takes to drive to work or get to work is an indicator of the viability of that rental. And there is a sweet spot. It is 18 minutes. An 18-minute commute time is going to have the highest statistical rental versus up or down. When it's lower, you tend to be going into a lower value area. And so because of that, there may be higher density, but the values tend to be lower in the markets that we're going into. We only go into secondary and tertiary markets right now, other than Houston, which is a contractual thing. And then on the other side, when it goes above that 18 minutes and when it pushes past 30, you start to be on an emerging market. And one of the things that we're tracking over the next 12 months is, how does that commute time change? Does it go down from 30 to something else? Or do we see the rental markets increasing even though that commute time is staying the same? And what that shows is one of two things. One, you're having a transition away from an urban center, or two, there is usually a secondary thing that has happened, factory reopening and that kind of stuff, where there's been a shift in where people are working. And that will cause that difference to occur. So as we move forward over the next 12 months, it'll be really interesting to see how that affects out. But our analysis points, really, we try to keep them very data grounded, and even down to how we evaluate visually a property. We have a computer vision model that we've been building that allows us to grab wider than standard angle Google Street View, which is variable in nature. And we actually are able to grade that on a scale of 1 to 10 to determine the visual viability of an otherwise data matched property. So the property on paper looks good, but does it actually match up? And sometimes we'll find a house, everything on paper says this should be one that we need to go after. And then when we run it through that, or we can just look at it and we're like, nope, this house is actually super clean. And in fact, it's the outlier in the area.
Great. Thanks for all that info.
Yeah. Sorry for the masterclass.
Love it.
Absolutely. All right. Anybody else? Any questions for Trevor? Brian, I think Khalil left, but Trevor and Brian are around. So please unmute yourself and ask away.
By the way, who just ran a property at 8752 South Manistee Avenue in Chicago?
Yep, I did.
There we go.
Very nice. Very nice.
Yeah, built in 1895, 6-bedroom, 4-bath.
And Brian, are you active in Chicago?
We're not. We will be. Chicago operates there's some legal compliance things that we have to work around within Chicago because they have what's called a pre-MLS requirement. And we want to make sure that we're always fully compliant on that side of it. So it's in process. It's a Q2 22
Sure.
Market for us.
Awesome. All right.
Yeah, there's a fourplex in Chicago I want to sell. So if anybody's interested.
I have investors that want Chicago. We can talk. It's just, it's not going to pass through the offer engine.
Okay, I'll send you email.
Awesome.
Let's see. Any other questions from anybody in the audience? If not, I will do a quick demo of Better Capital. I'll take only 5 minutes to do a quick demo, show you our updates, and then would love to, you guys have Brian's information and Trevor's information, so please reach out to them. And if you got any questions,
Bobby, I have to drop. My wife has opened the door twice, and she said, "When are you going to come up and watch TV with me?" So,
Brian, thank you so much,
guys. Thank you so much, Bobby. We'll talk. Let's talk next week.
We'll talk soon. Yeah, thank you.
Right.
All right, folks. Thanks for joining. I got a real quick demo of what we've been building for the last 18 months. It's called bettercapital.us, and what it does, it allows folks like yourselves and myself to track the actual performance of your real estate assets. So I'm going to just jump into one portion, which is most of us own some rentals. I can go into this property. I can see how my property is doing graphically. What's my KPIs? I can see all that in one place. I can have all my financials here, my investment financials, my ledger. These are all the transactions related to this property. I can run reports. I can run a Schedule E. This will be ready very soon. I think for next year, we'll have a Schedule E. You just click it. With one click, we'll create an Excel spreadsheet that'll have all of your Schedule E data for that property. You can store all your documents in one place. So if I click here, I can preview my documents. So here's my insurance information. I can preview it. I'll be able to share it. I can tag it. I can search for it. So if I do insurance, so all my documents that are related to insurance will show up. And then if I click on, let's say I click on lease, all my leases will show up. So it's searchable, it's taggable. So if I say, for example, I click on this and I want to add another lease, say renewal. Okay, now if I click on, if I search for renewal, it'll show up my renewal lease, and then I can preview it. So anyway, you get the idea. You also have all your contacts, your information about the property manager, the tenant, the handyman, what I call the power team or the local team for that property. It's all in that one place. But this platform is completely free to use. We built it for real estate investors, so you can track the actual performance of your real estate assets. That way you're not guessing, just like what Andrew talked about, knowing your numbers, what is your utilization? Well, the same thing applies to your real estate assets. We want you to, you bought an asset and you ran some Excel spreadsheets or some kind of a forecasting spreadsheet to see what you were predicting that property will perform. But now with our system, you can actually see the actual performance of your properties because we're dealing with actuals versus theoreticals. So, it's bettercapital.us. Feel free to check it out and give me your feedback. Tell me what you like, what you don't like, and what kind of features can we add. We're very agile. We're very nimble. Sometimes we get a request on a Friday, and by Wednesday, we've got that feature added. So I've got a great team. Jason's. I'm happy to say Jason's part of the team. But would love to. Yeah. Jason, if you want to unmute yourself and introduce everybody to yourself to everybody, that would be great as well.
Hi everyone, my name is Jason. I'm currently helping out Better Capital on the marketing side, and we do a lot of really cool things for real estate investors. We meet them, we help them track their platforms. It's been a great experience, and I highly recommend using this tool. And I use it currently for my own rentals, so it's great.
Yeah, thank you, Jason. And I also want to, Denise, I don't know if you're around, if you want to unmute yourself and introduce yourself. Denise is my friend, and she's going to help me grow Southern California in Pasadena area. But I don't know if you're on, Denise, but if you are, oh, there you go. There you go.
Hi, I'm here. Hi, my name is Denise Garcia. I'm a real estate agent in Pasadena, California. As Bobby mentioned, we're trying to grow our team or our meetups in Pasadena to be able to grow and connect with other investors in the area.
Yeah, so thank you, Denise. And yeah, if you ever need help in SoCal, reach out to Denise as well. But thank you, everybody. Look, I hope this was, a different event. I think you heard from some amazing entrepreneurs that have achieved, and they're building companies that are going to be around for a long time, and you'll hear about them more. But you got your first preview of meeting these folks on this meetup. So I hope I hope it was very useful. As far as Better Capital, it's completely free. We built it so that you could track your assets. And as you grow your assets, it's kind of like Robinhood for your real estate assets. Think of it that way. And but if you're not tracking the actual performance of your assets, you might be doing yourself a disservice. So it's very easy to set up. If you got any questions, reach out to me. You know where to find me. I'll give you a quick demo, or I'll send you a quick video. It's really easy to set up, but would love your feedback. So with that,
So Bobby, I'll give some feedback. This is Wendy. I've been using this Better Capital for a couple months now, and I absolutely love it. It's keeping track of my properties. It's instead of you not knowing really what your ROI is, it tells you exactly. So I'm behind it. I love it, and just wanted to give you a plug.
Thank you, my dear. Thank you so much, Wendy. Wendy is one of the most amazing investors that I've come across. And she actually pays attention to her numbers. So this is why we love her. She has multiple properties, and you know, she wants to know how her properties are doing. So we've set her up, and she's been using it, and she knows at any given time how each one of her properties is doing, what kind of equity, what kind of cash on cash ROI, what are her expenses, what is her income. Very easy to use, and so thank you, Wendy. That was totally unsolicited. But I will buy you. I will buy you a nice Starbucks coffee when we meet again. But maybe something more. But folks, look, reach out to me. Reach out to Jason, Denise. Ask questions. Like I said, it's not perfect, but we're making a lot of enhancements. By the way, very soon I'll give a quick preview. We're building calculators. So regardless of what, you could be on realtor.com, redfin.com, Zillow.com. You'll have a plugin from Better Capital, a free plugin, and you can go to any property and look at your cash on cash ROI. You can change the numbers without having to do anything except to install a Chrome plugin. But more on that later. We've got some really smart people working with us. So please, all I ask is give it a try. If you run into some issues, reach out to me. I'll help you. I'll onboard you. So, or Jason or Denise will help you. So, thank you, everybody. If you want to make any announcements, feel free to unmute yourself. If you have any needs, wants, you know, just unmute yourself and ask away. All right. I think we're good. Thank you, everybody. Have a good evening, and we'll talk to you soon. Have a great and successful week.
Thanks, Bobby.
Thank you, Bobby.
Lisa, it's bettercapital.us.
Thank you, Bobby. Very high tech.
Thank you, Sam. Thank you, Sam.
Thank you.
Thanks, Bobby.
Thank you, everybody.
Thank
All right.
you.
See you later.
Karen here.
Okay, bye-bye. Hey, Karen, bye-bye.
Bye-bye.
Hey, so I met Bettina today for lunch in Miami, and we were talking about you, so we're gonna get hold of you soon.
Oh, yes, we have to do lunch. We really, really do. Yes, I miss you guys both.
I know. We'll have to connect soon. And
Sounds good.
all right.
This was a
Say
great
hi.
presentation as well. Thank you.
Thank you,
Very
my
helpful
dear.
information.
Thank you. All right. Say hi to Eugene and hugs to the kids.
Will do.
All right. Take
Bye-bye.
care. Okay. Bye-bye.